Now, ratio analysis. When you talk about a ratio, then a ratio is simply one of the tools that are used for financial statement analysis and is usually an expression between variables. Now, in accounting, ratios are categorized into 5. We have the first category here, which we refer to as the profitability ratios. Now, profitability ratios simply give you different types of profits that are usually computed, or different types of profitability ratios that are computed, starting with the first one, which is the gross profit margin. Now, gross profit margin expresses the gross profit over sales. So if you take the gross profit over sales, then the resultant answer is going to be gross profit margin, and you divide that or multiply that with 100 to get the percentage. Then the next one will be the gross profit markup in summary. Now, gross profit markup, as you can see, is simply gross profit, not markup, but gross profit over cost of sales times 100%. Now, the first or the second ratio, that is gross profit markup, it simply tells you the profit that you loaded on the cost of production. So how much profit did you load on the cost of production? So that is gross profit over cost of sales. Then you multiply that times 100%. Now, this other one is profits on selling prices, while this one here is profits on the cost. Then we have the operating profit margin, which is obtained by operating profit over sales times 100%. That is operating profit margin. We also have the net profit margin given by net profit over sales times 100. You can see the formula. Another profitability ratio will be the return on capital employed, which is profit for the year over capital employed, then multiply that with 100%. Now, we'll also see that we have other ratios like return on shareholders' equity, that is ROCE, and also return on equity, ROE, that can be computed under profitability ratios. Now, we also have the capital employed, because you can see here they are saying that return on capital employed is profit for the year over capital employed. How then do you get capital employed? Now, capital employed is total assets minus current liabilities. Now, from profitability, we have the second category, which is the liquidity ratios. Now, liquidity ratios measures the ability to pay your current liabilities from your current assets. Is an entity able to pay its current liabilities from its current assets or not? Now, that is measured by using what we refer to as the liquidity ratios. Now, the first one being the current ratio. Now, current ratio is simply current assets over current liabilities, and they usually say the most preferred current ratio is 2:1. That means your current assets exceed your current liabilities. Then we have the acid test ratio, also known as the quick ratio. And acid test ratio is simply current assets minus inventories over current liabilities. So you take your current assets, deduct inventory, then you divide that with the current liabilities. Now, here we have also minus prepayments to be included. So minus prepayments, and that will give you the acid test ratio or quick ratio. Now, this ratio excludes things that cannot be quickly converted to cash. It uses quick assets. And in computing the quick assets, you take the current assets and you deduct inventory, and also you deduct prepayments. Then whatever you get, you divide with current liabilities. The most preferred acid test ratio or quick ratio is 1:1. Now, we have activity ratio, also known as efficiency, also known as turnover ratios. So these are also known as turnover ratios. They are also known as efficiency ratios. Now, these ratios measures how the entity utilizes resources that are at their disposal. How efficiently do you usually utilize resources that are at your disposal? That is measured by using the activity turnover, also known as the efficiency ratio. Now, the first one is inventory turnover. Now, inventory turnover is obtained by getting the cost of sales over the average inventory. Then the second one is inventory turnover period. Now you get the average inventory, then over cost of sales, and then you multiply. If you're doing turnover period in days, then you multiply times 360 or 365. If you're doing that in weeks, then you multiply with 52. But if you are getting in months, then you multiply with 12 months in a year. That's inventory turnover period. Then we have receivables turnover, which is credit sales of over average in receivables. That is the number of times that you convert sales or you make credit sales in a year. That is credit sales over average receivables. Now the receivables turnover period, the duration it takes for you to receive money from your customers, the credit customers, you simply take the average receivables, then over credit sales, and then you multiply that with 360 if you want in days, 50 if you want in weeks, and 12 if you want in months. Then we have average, the payables turnover. Now payable turnover measures the number of times that you make credit purchases, and you take the credit purchases over average payables. But if you want to get the number of duration, the period it takes you to pay your payables, then you take your average payables over credit purchases and you multiply with the duration, either in days, in weeks, or in months. Then total assets turnover, that is sales over total assets. And that gives you the how you are using your total assets, how your total assets are helping you to generate a shilling of revenue. So how are you utilizing your total assets so that you can generate some revenue? So that is sales over total assets. Now from that, we have the other category of ratios, which is capital structure ratios. The capital structure ratio, simply put, the composition of equity and debt in the organization. Remember, equity and debt usually affect the control and also affect the risk of the business. So the first one being debt to equity ratio. Debt to equity, the composition of debt, capital to equity capital. That is given by long-term debt over equity. Long-term debt over equity. The more the long-term debt compared to equity, the more control you may lose as far as your business is concerned. But if equity capital is more than long-term debt, then you still have a more control on your business. Now, leverage ratio, that is just capital employed over debt capital. So capital employed over debt capital. Now, capital employed is total assets minus current liabilities. Gearing ratio is the reciprocal of the leverage ratio. That is given by debt capital over capital employed, as that can be seen there. Then you have the debt ratio. Debt ratio is total assets, total liabilities over total assets. You simply take your total liabilities over total assets. It shows you how you finance your assets. Maybe you have assets that you finance majorly through debt capital or liabilities. Times interest cover ratio. This tells you the number of times that you can pay your interest, your finance cost, from profit before interest and tax. Then you add back depreciation. So if you take operating profit, then how much of interest can you be able to pay from your operating profit? Remember, operating profit is also known as profit before interest and tax. Now, this time round, you also add back depreciation. So those are the capital structure ratios. Then we move to the last category of ratios, which is shareholders ratios, also known as the investors ratios. So here, they are also known as the investors ratios, the investors ratios. Now, the investors ratios are simply try to explain the return on investment. How much will shareholders get from their investment in the business? And here we have earning per share. In advanced financial reporting, you are taught about basic EPS and also diluted EPS. You can see the first one. How do you get EPS? The earnings available for distribution. You know that earnings available for distribution you get after deducting preference dividend and divide that with the number of ordinary shares outstanding at the end of the year. So earnings available for distribution over the number of ordinary shares outstanding. Then the dividend per share, the amount of dividend that you paid, then divide that with the number of ordinary shares outstanding at the end of the period. So that is EPS and also DPS. Now from those two, you also have the dividend yield ratio obtained by dividend per share over your market price per share. The MPS will always be given. Dividend payout ratio, you get dividend per share over earning yield ratio, the earnings yield ratio, that is the dividend payout ratio. Then retention ratio, that is 1 minus dividend payout ratio, 1 minus dividend payout ratio. Then dividend cover ratio, we also have the dividend cover ratio, which is earnings per share over the dividends per share. I think this other one here should be over EPS, if I'm not wrong, earnings per share. This other one here should be earnings per share. The dividend payout ratio is dividend per share over earnings per share. And now retention ratio is what remains after you pay dividend. So 1 minus dividend payout ratio. Now dividend cover ratio is EPS over the DPS. So EPS over DPS. Price earning ratio is market price per share over earnings per share. Then earnings yield ratio is earnings per share over market price per share now. So this is the summarized ratios that we want to talk about in this particular course. I believe you did ratios somewhere in financial accounting and also financial management on your way to qualifying for this paper, Business Data Analytics. A question on ratio analysis up here, just scroll up, and we have a question on ratio analysis. The question reads, the management board of Zico Limited is reviewing the performance of the company for the year ended 30th June 2021 relative to 30th June 2020. The company is engaged in buying and selling various agricultural products, and despite challenges in the operating environment due to COVID, the results of 2021 are better than those of 2020. The company has presented the following financial statements for the 2 years. So we have 2020 and 2021, the statement of profit or loss. We also have 2020 and 2021 for the statement of financial position. We also have the statement of financial position. Then after that, it is required. Compute the following ratios for each of the 2 years. Net profit margin, return on equity, current ratio, quick ratio, debt equity ratio, inventory turnover ratio, and total assets turnover ratios. Then using the financial statements and various ratios, comment on the performance of the year 2021 compared to the year 2022 with respect to profitability, liquidity, solvency ratios. Now we have prepared here already, there's a summary of what we want to cover. Now in this case, we'll be covering much more than what was asked. So as we cover profitability, as we cover liquidity, activity, capital structure, and shareholders ratios, then we'll be covering everything that has been asked in the required part here. So we'll be answering more than what was required. We start with profitability from the formulas that we now know. Gross profit margin is gross profit over sales. So if you want to get gross profit margin, then you take gross profit over sales, and that is equal sign for 2020. 2020 equal sign, then go to the SOPL, look for gross profit, which is here. This is gross profit. Divide that with revenue. So that is gross profit over revenue. Gross profit over revenue, enter, and you can see the answer is 25. If you are not getting 25, let's say maybe yours is still formatted in general and you're getting such an answer, then you simply click on the percentage sign, then convert that to 2 decimal place by increasing or decreasing the decimals here. drag across to have the other answers. Gross profit markup is equal sign. Again, click on gross profit, divide, that is slash, but now negate. So minus, that is hyphen. Then click on the cost of sales. We are negating because this is negative, so it will be cancelling the negative that is on the cost of sales so that we can get a positive markup or a positive percent. Then just drag across for the gross profit markup. Now net profit margin will be, move down and click on net profit for the year. That is profit for the year, which is here, 59,081. Divide that with the revenue, enter, and simply drag across, and that will give you the net profit margin. We are doing operating profit margin, that will be equal sign. Click on operating profit. Where is operating profit? Profit before interest and tax is operating profit, which is 130,081. Remember, profit before interest and tax. Interest is the finance cost, tax is huku mbele, so this is operating profit. Divide that with revenue, enter, then you can also drag that across, and that will be profit. Operating capital employed, because the next one is return on capital employed. So capital employed will be total assets minus current liabilities. So equal sign, then find total assets in the statement of financial position. These are total assets minus current liabilities, and current liabilities are here, 814. These are current liabilities. So 1357,644 minus 814,322. Enter, and you are going to get your capital employed. Now then return on capital employed. The return on capital employed will be equal sign profit for the year, so profit for the period, divide that with capital employed, and we have capital employed just up here. So profit for the year, profit for the period over capital employed. Then you drag this across to get your answer. Then return on equity. Now the return on equity is profit for the year, profit for the period over equity. Now equity is given over equity. Equity is 438. You can see capital and retained earnings. This is 438. That is equity. Profit for the year over equity, and equity is 438,350. Summation of capital, share capital, and retained earnings. That gives you equity. Then drag across for the return on equity. If you have to provide comment the way part B of the question wanted, then if you look at 2020 and 2021 for profitability, margin 2020 is better for 2020, it's better than 2021. Markup 2020 is better. Net profit margin 2021 is better. Operating profit margin 2021 is better. Return on capital employed 2021 is better. Return on equity 2021 is also better. So you can see that at the end of the day, if you look at this, the most important part could be the net profit margin, the end profit, and 2021 performed better than 2020. Operating profit margin, you can also see that 2021 is better than the other periods. So slightly for margin and markup, 2020 is better, but by far margin, you can see net profit margin and operating margin are higher than the 2021. So I'll go for 2021 as having better profitability compared to 2020. The end result for net profit margin and operating profit margin matters a lot. Liquidity ratios, ability to pay your liabilities, current liabilities. Current ratio is equal sign. Go for current assets, and current assets are 1,098,000. Divide that with current liabilities, and current liabilities are 919,294. 919,294. Enter, and that gives us 1.19. Now for acid test ratio, it will be equal sign open bracket, equal sign open bracket, because you deduct inventory. So So that means equal sign bracket. Current assets, the total current assets minus inventory. Inventory is 382. Close those brackets. Then that is what you'll divide with. Then after that, you divide with the current liabilities, which are 919. These are the current liabilities. So open bracket, then the current assets minus minus the inventory, close bracket, then divide that with the current liabilities. So that gives you 0.78. Analyze the liquidity ratios. They also wanted us to comment on the liquidity ratios. So for current ratio, this is 1.1, this is 1.0. For acid test, this is 0.78, this is 0.76. In both years, the company is able to pay its current liabilities from current assets. But the superiority of paying liabilities from current assets is higher in 2020 compared to 2021. You can see the ratios are stronger in 2020 compared to 2021. So they were more liquid in 2020 compared to 2021. We want now to move to activity ratio. Activity ratio. And under activity ratios, we start with inventory turnover. So inventory turnover will be equal sign. Inventory turnover equal sign. Cost of sales. So equal sign then negative. Then take the cost of sales. This is the cost of sales. You negate to make it, to cancel the other negative on cost of sale. Over then open bracket. Cost open bracket. Two brackets, open two brackets, over average inventory. But for the first period, there is no average inventory. There is no average inventory for the first period because it's 2020. For you to get average, you need for 2021. So that will just be equal sign negative over, remove the brackets, divide that with inventory. Only one inventory that you have because you cannot get the, there's no way we are going to get average if we are in 2020. So just take negative the cost of sales over the one inventory that you have. Enter, and that will be 3.94. 3.94. Don't drag across. Don't drag across. Because the other one requires average inventory and it will be equal sign negative. Equal sign negative. Click on the cost of sale. Cost of sale. Divide that with, then open bracket, two brackets, open two brackets, then click on the first inventory in 2020, you're getting average, plus click on the inventory in 2021, close bracket, then divide with 2, then close another bracket, and enter to give you 6.34. Now, on to the inventory turnover period. The inventory turnover period, now that will be equal sign. It should be now average inventory, and for 2020 you only have one inventory. I want you to open bracket, then take the inventory, divide with the negative cost of sale. So click on the cost of sale, negative cost of sale. Yeah, then close bracket. Multiply that with the, I'm assuming 365 days. So assume 365 days and you enter. That will give you 93 days. That will be equal sign. Equal sign. You can open the bracket. Open the bracket, then we start with the, I think it's two brackets, open two brackets. Average inventory is the first one, plus the second one, divide that with 2, divide that with 2, close bracket, then over, negative, then go and click on the cost of sale. The negative is to negate it so that it can be positive. I think we needed 3 brackets because this needs to be closed, and therefore we need another opening bracket at the beginning. So we'll add another opening bracket at the beginning so that we can have 3 brackets, or 2 are enough. Now only 2 brackets are enough. You can remove 1 at the beginning, then multiply this with 365 times 365. So this is opening inventory plus closing inventory over 2, closed in bracket, divide with the negative cost of sale. The negative cancels the cost of sale, which is negative, then multiply with 365 and enter. The days are 79. Now receivables turnover, this will be equal sign. Receivables turnover will be equal sign, uh, equal sign, then we need what? Credit. Assume that all the sales are on credit in this case, because receivables turnover is credit sales over average receivables. So equal sign, then click on sales. Assume all of them are on credit over receivables. Now for the first period, you cannot get average. Just use one as it is for 2020. The average will be done if you have the one for 2019 as well. So 3.13 times, 3.13 times. Now for the other one, it will be equal sign. Then again, click on the revenue, divide. Then for 2021, that will be equal sign. Then again, pick the revenue over, then open bracket, because now we can get average, goes two brackets. We can now get average. The receivables for 2020 plus the receivables for 2021, close bracket, divide by 2, then close another bracket. You can see this is sales over average receivables, which is in bracket here, opening plus closing over 2 in bracket. To receivables turnover in days, we now interchange the formula, and that will be equal sign turnover in days. Now you take average receivables, and for the first period, just do equal sign bracket. Take the receivables, which is 647, no need for average, because we only have one. Divide with revenue. You interchange and divide with revenue. So receivables over revenue, close bracket, then multiply times 365 times 365. That is going to give us 117 days. Now the other one will be this other section, equal sign. Now we have the average, two brackets open, opening receivables plus closing receivables. So opening receivables plus closing receivables, close the bracket, divide by 2, close again. Then that will be divide by, do we need 3 brackets? Divide by the sales. Now the sales are 43, that is divide by the sales. I think we need another, that is 1 closed, 2 closed. We need another bracket for that case, because we need to multiply times 365. So average receivables over credit sales times 365. So another bracket, then another bracket, then that is when it's multiplied times 365. So I've added another bracket at the beginning so that we multiply times 365. So 104 days, we can confirm that, 104 days. Inventory turnover, the inventory turnover did not have 3 brackets, and the reason for that is because there's something that we did wrong here. This one is supposed to be closed. This one is supposed to be closed, and therefore we need 3 brackets as well. Needs to be the same, 3 brackets as well. And enter. The answer is 58. You see that affects the answer even up there. So it's there was supposed to be a bracket somewhere here. Another one will be total assets turnover. That will be revenue over total assets. Just revenue over total assets, and total assets are 13, 57,644. Then you drag this across. This becomes your assets turnover. Assets turnover.
Comment on that one.
Capital structure. We start with the debt ratio. How do we get debt ratio? Debt ratio from the formulas that we had here. Debt ratio is long-term debt over equity capital. not total liabilities over total assets. So total liabilities over total assets. So take total liabilities and divide with total assets. Now total liabilities are 19. Total liabilities are 919. Divide that with total assets, which are 1357. And you are going to get 0.68 and the other one. Something is telling me that I used wrong values when we were getting liquidity. We can review liquidity. What were we using? That was of yeah, it's not supposed to be total liabilities. So liquidity ratios, I've just remembered when I was speaking that the liquidity ratios are wrong. So this should be, the current ratio should be current assets over current liabilities. So it should be over 814, not the other total. This is total liabilities. So it's wrong. Change that and drag across. So it is current assets over current liabilities. Acid test ratio as well. Use the correct denominator. It should be over liabilities, current liabilities, not total. Current liabilities and not total liabilities. That should also be adjusted this way. So I've just remembered that. This is long-term debt over equity capital. The long-term debt over equity capital. So that is equal sign. Now long-term debt is long-term debt is 104. You can see the non-current liability, 104, long-term debt over equity, which is 438 up there, just up there, 438, 350. That is the equity capital. Ordinary shares and retained earnings, that is 0.24. Then you drag across for our final answer. The gearing ratio is debt over capital employed. Debt capital over capital employed. Debt capital is which one? Long-term liabilities. Long-term liabilities, the debt capital over capital employed. Now, capital employed had been obtained up there under profitability. So over capital employed, which is 543,322. 543,322. Total assets minus current liabilities. Total assets minus current liabilities. Now, long-term debt, do we use total liabilities or only non-current liabilities? Debt capital. Debt capital, non-current liabilities. Debt capital will only be non-current liabilities, and therefore we change the numerator and the numerator to pick only the non-current, which is 104. 104. So gearing ratio, debt capital over the capital employed. So 0.19, then you drag across. Reciprocal, leverage is the reciprocal. You will simply take debt capital, which is the long-term liabilities, the non-current liability, divide that non-current liability, and then divide that with the capital employed, which is here, 543,322. Then we're getting the same answer. So we change. Now capital employed, pick the capital employed, and divide that with capital employed, divide that with the debt capital, that is the non-current liabilities here, non-current liability. That will give you 5.18. You can just drag across after you've gotten that. Times interest cover ratio. You take interest, so equal sign negative, because interest is given as an expense, or if not, so finance cost. So equal sign then negative to make it positive. Click on the finance cost. Not finance cost, it's not finance cost, that is wrong. It will be over finance cost. So equal sign, remove the negative, equal sign, Then operating profit, that is profit before interest and tax. Profit before interest and tax, the 130. Divide by negative, then click on the finance cost now. Click on this finance cost. So the 130,081 divide by the negative to make this positive, 44,600. So 2.92, the number of times that you can pay the finance cost from the operating profit. Remember, depreciation, if there, is supposed to be added back. Now on to the shareholders, the return on shareholders. Start with the capital share, or simply put share capital. This one is share capital. Share capital, the number of shares, or just take the share capital as it is, 80 and 80, that doesn't change. This is share capital. Share capital. Price per share will be 10 bob. 10 bob, they say that it's 10 bob. Par value is 10 bob. It's given even in the question, it's 10 bob. It's here. The price per share is 10 bob. Number of shares, that will be equal sign 80 divided by 10. The number of shares are 8,000 and that runs across 8,000. EPS, now EPS will be equal sign profit for the year. You use earnings attributable to ordinary shareholders. In this case, you simply use profit for the year because there is no preference dividend to be deducted. Simply use profit for the year and divide that with the number of shares outstanding. The number of shares outstanding are 8,000. So profit for the year over 8,000. And you can see the EPS over the 2 years. EPS over the 2 periods. So it had increased in the other period of 2021 compared to 2021. Shareholders received more in 2021 compared to 2020. Now, dividend per share is dividend paid, so equal sign negative. Equal sign negative because this is a negative dividend paid in the SOPL. Divide that with the number of shares, which are 8,000. So equal sign negative. You click on the dividend, divide with the number of shares, drag across, center. Then you can see DPS was 3.81 and the other one had increased to 8.1. So the shareholders are gaining more in 2021 compared to 2020. How do we get dividend cover ratio? Dividend per share over earnings per share. We can confirm that. Dividend per share over earnings per share for the dividend cover ratio. Now, dividend cover ratio, dividend cover earnings per share over dividend per share. Earnings per share over dividends per share. So that is the dividend cover ratio. Earnings per share should be earnings per share over the dividends per share. Earnings per share over the dividends per share. Then you drag this across. Now, generally, you can see that the year 2021 has done better in terms of shareholders ratios compared to 2020. So that was summary of ratio analysis concept and ratio analysis concept that can be done in Excel. There are more ratios that can be covered apart from what we've just seen there.